Hey, this is Dr. Matthew Loop here. Welcome to this training. I have a very special guest with me, Hannah Kesler. She's going to be sharing just an amazing strategy that many of us, especially doctors, entrepreneurs, can use to keep more of what we make and grow it faster, and then essentially be our own privatized bank. This is a strategy that the world's wealthiest people have used for a couple hundred years. She'll go more into that in the history because she's very well versed. And it's funny, it's interesting timing that we're doing this call because this last week I'm actually using this method. I'm finally getting to realize it to take advantage on an automobile that we're going to purchase. And I'm kind of kicking myself that I only started one policy back in the day, and I'm like, oh, geez, this is ridiculous. So yeah, now we're going to reconsider, and I should have this for everyone. So, thanks again for tuning in. If you're coming on, just let us know where you are coming from. We have docs from all over the world. Today, we are going to do a Q&A session because there's going to be a lot of meat and potatoes in this, and I want to make sure that we cover all the grounds. So I'm going to just share how Hannah and I first met, and then I'll give her the formal bio, and then we can get into today's presentation. So, as you guys know, I host the Social Media Revenue Summit here in Atlanta, and she's actually going to be presenting. And they've upped it to they've stepped forward to the VIP Platinum sponsorship this year on August 15th at Porsche Experience Center. So we met a few years ago when her father Brent was um, actually, no, this was in the Bahamas, actually. We first met in the Bahamas. Then they came to speak at our event in Atlanta. And the concept in Brent blew the audience away because these are things that were not taught in school. And it's probably one of the more popular presentations that we'd ever had because we're taught how to kind of earn, or if you're consulting and coaching, you learn from great mentors. They'll teach you how to grow practice or your business. But in terms of actually making that money work for you in a safe, reliable way that just multiplies over, years and years and years, that's not something at least I was taught in school. So we connected, we hit it off immediately, and obviously they've treated a lot of my clients very well over the years. And then turns out we've had so many mutual friends and clients that have worked together in the past. So I just thought this was a natural synergy to bring her on, Hannah, on the presentation today. So let me read you her formal bio, and then we'll get into what we have. So Hannah is a second generation to the infinite banking concept. This is a method Hannah and her father travel all around the country to teach how to recycle, recapture, and gain total control of your hard-earned dollars. The Money Multiplier teaches the importance of privatized banking, keeping money in the family, and how to break the bonds of financial slavery. We're both agreeing on that the Fed's a Ponzi scheme, and she's probably going to talk a little bit about that today. But you don't even realize that you're in it sometimes. So Hannah's going to be showing you all the ways to get money back for every car, every equipment purchase that you ever buy for you and your family for the rest of your life. It works for anything, essentially, product, services, and investment. Hannah even shares her journey on stages like New York Academy of Medicine, NASDAQ, New York City Bar Association, and has been featured even on the New York Times Jumbotron. So, from privatized banking to money lending to investment purchases, Hannah loves teaching others how to create wealth and freedom for today, but also for generations to come. Hannah, thank you so much for joining me today.
No, that was good. Thank you, Matthew. Hey, and y'all, so actually speaking about car purchases, I'm in my van right now. So I live van life. I'm in my conversion van, and this is my second conversion van because long story short, I live in Florida. That's home base, Daytona Beach now. And a hurricane hit us back in October of 24. So it flooded my first van. And so this is my second one, and I use my policies to finance this. And hey, I'm getting all the money back because I filtered it through my own banking system first. So I am going to share my screen here. I'm not going to go through everything today. All right. So I'm going to get more into stuff when we are together in Atlanta on August 15th, which is going to be a day after my birthday. So I'm excited to share my birthday with y'all. But I really just want to get into the meats and potatoes, okay? Because I will just saves us some time so that after this we can get deeper into questions that y'all have for me. But
And I just wanted to say before you start, Hannah, too, Liz, that we connected also. What really brought this out, you spoke at the seminar and your dad as well. And I was like, we connected at a separate gentleman, Clint Arthur's event. And, it reminded me of being in the room with high-powered people and the conversations that you have. And, a bunch of givers. And you always struck me as somebody that wants to give value to people. And you've seen a lot of stuff over the many years in the conversations that we had about the infinite banking and or the private lending. I just think that it's such a massive value. So you got to be in the right rooms and the right environment. So follow her on her social media accounts or whatnot. She's talking about things that are just going to elevate the quality of your life. I promise you. So check out her podcast, but go ahead, Hannah.
No, thank you. Thank you. So yeah, and my podcast is called the Money Multiplier Podcast. If you want to go and give that a follow. And so that is our company name, the Money Multiplier. And y'all, I'm not here to sell y'all anything or ask you to buy anything, okay? So you can go ahead, put your credit cards, your checkbooks, your social security numbers away. We're just here to learn. And I want to teach y'all about a concept that's called the infinite banking concept. And some of y'all, maybe you have heard about this before, but maybe it's never been explained to you in this way. And some of y'all, maybe this is the first time you're ever hearing about this, and I'm about to challenge your conventional thinking when it comes to your money. Because the thing is, you are really, really great at making your money, but you suck at keeping it. So I don't want you to change anything that you're already doing. You're doing really great at making the money. It's just how do I keep the money that I'm already making? I don't want you to take on any additional risk or lose control of your cash flow. We're just going to change where that money goes first. So I'll get into it. You can also see my contact info on the screen. That's my cell phone number, my email, and then our website, themoneymultiplier.com. So, just real quick before we get into it, who am I? Hey, I'm Hannah. So, as I mentioned, I know Jake, you're over there in Kansas City. I actually grew up in Olathe, Kansas, so I'm a Midwestern girl at heart, but moved to Daytona Beach in 2018. So now that's our home base now. But when we were living in Kansas City, so you see that bald-headed guy right up there on the screen? That's my dad, and his name is Brent Kesler. And dad, he's actually a chiropractor. So when we were living in Kansas City, he had 6 clinics in the Kansas City area. He no longer practices chiropractic anymore. He sold his last clinic in 2017, and he had associate docs in all of those clinics. And actually, that was my first ever job when I was 14 years old. I was the CA at one of his offices. And then I got fired, but that's a conversation that we can have at another time. But dad, this was back in 2006. He was actually at a chiropractic convention and there was a gentleman up on stage teaching about this concept. And dad was like, "Okay, this stuff is good, but it kind of sounds too good to be true." I mean, have you ever heard something like that? Something too good to be true? So what dad did is he bought Nelson's book. I'm going to talk more about this black book here in a second. But he bought this black book, he went home, he set the book on the shelf, and he didn't do anything with this information. 2 years later, 2008, he went back to that same chiropractic convention and he was greeted by about 10 or 12 of his colleagues who were coming up to him, hooting and hollering about this banking concept. They're like, "Brent, isn't this concept so cool? I'm able to pay off my debts, pay the salaries of my key employees, finance the adjustment tables, and I'm able to recycle and recapture all of that money that I spent back to myself." And that's when dad was like, "Okay, there's got to be something to this. I mean, no way 10 or 12 of my closest colleagues could be lying to me about this stuff. I mean, maybe one or two of them, but no way 10 or 12." So that's when my family took action, was back in 2008. And at that time, dad had almost $1 million in debt. And from being from Kansas City, you can kind of understand, okay, how can you be almost $1 million in debt living in Kansas City? I know in California it can buy you a very small house, but in Kansas City it can buy you a lot. So, he had his student loans from chiropractic college. He's a pilot. He had airplanes, he had rental properties. So it really didn't take him a lot to get him to that $1 million of debt. And by implementing this concept, he was able to pay off that debt in 39 months, 3 years and 3 months. He didn't work any harder, take any additional risk, open the office for longer hours, or treat more patients. Again, he just changed where that money was going first. So I started to get around this concept when I was 8 years old and starting my first bank, my first private bank at the time I was 18. So now being 26, I just eat, live, and breathe this stuff. And I'll get more into my story here in a second. But you also need to know who the other gentleman up there on the screen, R. Nelson Nash. So Nelson is not the inventor of this concept. I mean, this concept's been around for over 200 years. I mean, longer than our tax code's even been here. But Nelson is really just the gentleman who brought this concept to the public's eye. So this book, Becoming Your Own Banker, I highly, highly recommend you add this book to your wealth building library. So you can go to Amazon, go get the book that way. You can even buy it from us at the Money Multiplier. But honestly, I'm not in the book selling business. Just go and buy it wherever you go and buy your books. But I just want you to know where all of this information is coming from. And if you got a little ADD like myself, it also comes with the 2 hours of audio. So I like the audio as well. But just so you know where all of this information is coming from. Now, here's just a little gift, okay? Because I know you're spending some time away from your business, away from your family here this afternoon. If you send me an email, Hannah at themoneymultiplier.com, Hannah spelled the same ways forwards and backwards, I will actually send you a copy of our ebook, Mapping Out the Millionaire Mystery. So, this is a book that my father and my business partner, Chris Noggle, wrote together. It's a great resource. It's an easier read, I would say. But if I had to choose a book, I would rather go read Becoming Your Own Banker and then read this one. But here's just another resource for y'all as well. So you can send me an email or you can even scan the QR code and get the ebook that way. But it's another great resource to get deeper into this. And I would also encourage y'all, Chris Noggle, if you don't know who he is, he's very active in the real estate space. He actually had a show on HGTV at one point called Risky Builders. So go follow Chris Noggle, see what he's posting out there on YouTube, Instagram, Facebook, TikTok, wherever you like to spend your time on social media and kind of see a lot of the educational content that Chris Noggle is doing as well. So, as I mentioned, I'm going to skip over some parts, but here is something that I want y'all to do later on this evening when you go home tonight and study this stuff in nauseating detail, okay? Because this concept that I'm about to share, this is totally outside the box thinking. It's not what your parents are doing, it's not what your friends, your boss, your colleagues, your coworkers are doing with their money. And it's going to get a little uncomfortable in here, and I'm going to challenge your thinking of how we've been taught to handle our money up to this point. So, to get us in the right mindset, I normally like to play this backwards bicycle video. So tonight, go to YouTube and look up the backwards bicycle. It's about 7.5 minute video, and it just gets our minds geared into being open and receptive to new ideas and new ideologies, if you will. So I'll play a short little snippet. So when you go and study up on this, you know you're on the right
Hey,
video.
it's me, Destin. Welcome back to Smarter Every Day.
All right. Now there's a guy by the name of Will Rogers. And you know what Will Rogers says? He says the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So again, a lot of the things that we've been taught about money, dollars, and wealth may not actually be the truth. And I want y'all to keep an open mind as I go through this. And I promise we're going to have some Q&A after this. I'll give you my cell phone, my email. We can talk one-on-one after this as well. But write your questions down, okay? Don't just try to keep them up here because you're going to forget them. I want you to write them down and I promise I'll answer them. My dad has always taught me a short pencil is better than a long memory. So write them down and I'm going to stick around and we can get through as many questions later on. All right, we're going to get through how does your money flow and the method to get all the money back. Y'all, before I get done here today, I'm going to show you how to get all the money back for just the equipment that you are buying for your office whatever practice that you're in, whether you're a chiropractor, whether you're a dentist, a physician. I'm just using the example of an equipment because we can all kind of understand that x-ray machines, the decompression tables, yada, yada, yada. But it's not just for the equipment. It's anything and everything that you're buying in life. Just like how Dr. Matthews said, hey, I'm using this to finance the car. That's what I did here with my van as well. I bought the van. I'm able to get all the money back for it. So we'll get into that. But before we do, let's get into some of this fun stuff. You can see that there's three calculators up here on the screen. Let's make believe that we are in the market and we want to go buy ourselves a car. I don't care what it is. Let's just say it's a car. And I'm going to make believe that down at your local savings account in your bank, you have $25,000 that's sitting there at the bank, and you want to go buy yourself a $25,000 car. And we're going to make believe that you found a really, really good bank, and this bank is paying you 4% on your money. Okay, I know they may not be, but there's method to my madness here, okay? Just follow me. So we're going to make believe that you found a really, really good bank, and this bank is going to pay you 4% on your money. So you walk into the bank, and let's make believe I'm your bank teller. And you come up to me and you say, Banker Hannah, I want to take out that 25,000 that's earning me 4% interest, and I want to go pay cash for my car. And y'all tend to bump up your chest like that. I want to go pay cash for this car. Y'all love paying cash for things. You think when you pay cash for stuff, you don't got to pay any payments and you don't got to pay any interest. But is that the truth? Ponder on it. We'll come back to it. So you walk in and you say, Banker Hannah, I want to take out that 25,000 that's earning me 4% interest, and I want to go pay cash for this car. And I turn to you and I say, no, no, no. Instead, how about I make you a loan for 25,000? I'll loan you the 25,000 and I'm going to charge you 6% interest. Okay. If I were to take out that loan of 25, I mean, how long is it normally going to take me to pay off that loan? 4 years, 5 years, 6 years? Let's just go with 5 years or 60 months. Instead, how about you take my loan of 25,000? I'm going to charge you a 6% interest. And over the same equal time period of 5 years or 60 months, our bank is going to pay you more money on the 25 that you're earning at 4 than you'll pay us on the 25 that you're borrowing at 6. Is that a true statement? So in other words, can I make money earning at 4% at the same time I'm paying 6? I mean, my simple mind is thinking, well, no. If I earn 4, pay 6, 4 minus 6 equals -2. As us Gen Zers say, that math ain't mathin'. But the banker told you the truth, and I want to walk through it. If you took out that loan of 25,000 charged at 6%, your monthly payment over the 5 years is $483.32 a month. Take the $483.32 times the 60 months, you just paid $28,999 for the car. So 25 in principal, about $4,000 in interest. Over the same time period in your savings account over the 60 months, your balance is $30,525. So here's my question. Is this $30,525? Is this a larger number than the $28,999? Or do y'all do math differently than what I do over here down in Florida? Now in New Mexico, but down in Florida, right? I mean, it's a larger number. But how can that be a larger number? Because I thought if I earn 4, pay 6, I'm losing some. Here's what's going on. Inside of this savings account, this is on an increasing scale. This is going up each and every month. While your payments on your loan, this is going down each and every month. You're paying down that balance. So one's going up and the other one's going down, but our minds are not programmed to think this way. See, people love to get hung up in rate. Oh, I have a great rate. Oh, my mortgage interest rate is at a 4%, a 3%, a 5%, right? I mean, y'all can have pretty good rates, but y'all, it's not the rate that's killing you. It's the volume of the interest that you're sending out the door to other people. So, on that same analogy, right? Most folks in here, you guys probably have a mortgage, right? And again, you guys probably have a great rate. It could be a 5%, a 4%, a 6%. It doesn't matter. But when you get your mortgage statement in the mail every month, you'll notice that there's a payment section and then there's an interest section. Is that interest section really 5% of your payment? Or is it a lot higher than that? It's a lot higher than that. So again, it's not the rate, it's the volume of the interest that we're sending out the door. And y'all, this is just math. I mean, I did a real life example one time on my podcast show where I showed the example of earning at 10% at the same time I was paying at 20%, and I still came out on top earning at 10 at the same time I was paying 20. We got to start learning how money actually works. So, I told you there was a method to my madness. Let's talk about the machine that we're using to build our wealth. A whole life insurance policy with a mutually owned company that pays dividends. Now, I get it. Before you run out of the room and you slam down your computer and you vomit on me, you're thinking to yourself, Hannah, I know everything there is to know about whole life insurance. Dave Ramsey and Susie Orman, they told me whole life is the worst place to put my money. I get it. I mean, my dad was a Dave Ramsey's baby step follower. Do you get why it took him 2 years to start this stuff? But here's my question. Why whole life? Why whole life? And you can put it in the chat box. And when I go and I travel around, teach on this live, I get a lot of good responses back from the audience. But here's the number one reason. This is what the elite and the wealthy are doing. The number one purchasers of whole life insurance in the world are conventional banks. Banks actually own more in whole life insurance than all of their land and their buildings combined. And a matter of fact, since 2013, banks have even quadrupled in their portfolio of how much whole life insurance they actually own. And it's like, are banks stupid? Or are banks doing something the rest of us just don't know about? They're probably doing something. And don't just take my word for it. Go and Google this stuff. Go look up BOLI, BOLI. It stands for Bank Owned Life Insurance. You can look up the hundreds of pages that come up of how much whole life insurance these banks actually own. And no, it's not an IUL, an EUL, a VUL, an EIEIOUL. It's whole life insurance. Now, I want to be specifically clear here, though. This is not just the traditional whole life policy that you can go and buy off the shelf from your brother-in-law that sells life insurance. We all got a brother-in-law that sells life insurance, do we not? It's not that type of traditional policy. This policy has to be designed specifically for high immediate cash value. So, what I mean by that is when I put my premium deposit into that policy, immediately, my definition of immediately is within 30 days, there's cash value in there that I can take out the cash value and I can use it for whatever I want. So it has to be designed specifically for high immediate cash value. Now, let me go back because why was my 4 and 6% important? Inside of the policy, you get a guaranteed interest rate. You get a guaranteed interest rate in that policy. And that's just not my flabbing gums telling you that. That's written inside the policy contract itself. And the highest interest rate that the insurance company will charge you to take out that policy loan is 6%. So again, can I make money earning 4 at the same time I'm paying 6? Yes. Okay, let me move on. Oh, I just totally stopped the share. There we go. I'm going to scroll down here because I want to get into just a little bit. I'm not going to get deep into how banks work, but just so you kind of understand the premise, okay? When you take your money, or I should even say this, because we got to make money to live on this God given earth we call America, right? We got to make our money. And when we go and make our money, well, what are our options? Where can I go and store that money? Well, number one, I could go leave it at the local bank because, well, that's just where they keep the money at. Or I could keep it on cash on hand, right? I could have a safe in my house. I could dig a hole in my backyard. I could leave it underneath my mattress. But I don't really want to do that because if I do that, then I'm subject to flooding or fire or the hidden tax called inflation. Or number three, I could go give it to my financial advisor who thinks they can manage my money better than I can. Right? And have you ever noticed the only time you actually lose money is when you give up control to somebody else? So those are like our three options, right? Well, let's talk about it. Why do we keep money at the bank? Well, Hannah, I don't know. That's just where they keep the money at. When you deposit money into the bank, that deposit into the bank is now a liability to the bank. Why is it a liability to the bank? Because they got to pay you interest on it. So, how does the bank turn that liability into an asset? They loan it, right? Banks are in the lending business. They lend out your money to you or to other people, and they make a good living off of it. So, who's ever gone down to the bank, asked to borrow money to purchase a house? Let's call it 7%. Bank issues you the loan, you go open up the mortgage, and now I got to pay the banker back. I got to pay them back with interest because if I don't, they're going to come and foreclose on me. So money goes back into the bank. What about a car? Let's call that 8%. Bank issues you the loan, you go buy the sexy new automobile, and then now I got to pay it back on time because if I don't, I'm going to hear that beep, beep, beep as a tow truck is coming and towing it off my driveway. So money goes back into the bank. Or home remodel, like a swimming pool, granite countertops. Bank issues you the loan, you go pay off all the contractors, and the money goes into the bank. Lastly, let's do a debt consolidation. Bank issues us the loan, 12%. We go pay off all the credit cards, and then money goes into the bank. Now, I want to see how well we did compared to how well the bank did. Because here, I'm earning 4% at this bank. I found a really good bank and they're paying me 4%. And I know math is not everybody's favorite subject, but we're just going to do a little bit of math. But I promise I'm going to keep it very fun, very easy, okay? Because I want to know how well I did compared to how well the bank did. So in the first transaction of the house, the bank made 7, we made 4. 7 minus 4 equals 3. I told you it was going to be easy. And then in the car transaction, bank made 8, we made 4. 8 minus 4 equals 4. Home remodel, bank made 9, we made 4. 9 minus 4 equals 5. And then lastly, the debt consolidation, bank made 12, we made 4. 12 minus 4 equals 8. So if you add all of that up, the bank made 20% and we made 4%. I mean, how well did the bank do than us? A lot of y'all are probably thinking, well, 16%, right? Hannah, because 20 minus 4 equals 16%. No. How about 500% better than us? Because doesn't 4 go into 25 times? Y'all, banks are making no less than 400% annually on the money that you leave there with them. And again, here's another resource. Go and look up BauerFinancial.com, BAUER, BauerFinancial.com. You can look up the big banks that we all know the names of, or your small hometown banks, and go look at their annual reports. And I truly challenge y'all to look at this stuff because my father has been traveling around. I've been going with him ever since I was 16 years old. And we've been asking every single audience this since 2012. Find me a bank that makes less than 400% annually on the money that you leave there with them. It hasn't happened. But see, it kind of makes sense, right? Because, not to go so advanced into fractional reserve lending, but here's what's happening. These banks are taking your money and they're lending it out to you or to other people. And what they can legally do is for every $1 that they have held backhand on their reserves, they can now go lend out $8, $9, $10 for every $1 that it has held on its reserves. And these banks are playing a big game. Well, I hope and I think that not everybody is going to come and do a run on the bank and request all of their money out at one given point in time. But okay, 2023. How well did that happen to y'all, Silicon Valley Signature Bank? Didn't y'all have to go belly up? And then what happened is the Federal Reserve System opened its printing press over its back doors and just started to turn on the printing machine, printed out all the money so there wouldn't be any uproar in the streets. And then now we're so confused why costs of living, eggs are so expensive, yada, 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 inflation, right? I mean, this is why I have a big passion that we just need to abolish the Federal Reserve System, but that's my opinion. But see, what I'm saying is that y'all are doing this stuff in your lives anyways. You're buying houses, you're buying cars, you're doing home remodels, and you're using credit cards. So why don't you just be the banker in your own life and you make that 500% on yourself rather than the bankers making a good living off of you? But I get it, right? I mean, we're just not taught this stuff. Nobody, the elite are not sitting down with us at our kitchen tables and saying, hey, this is what we're doing, right? So honestly, now that I know this game, I'm just playing the game right along there with them. All right, I'm going to skip through this. My last thing I want to get into, I want to show y'all a practical example, okay? And this is actually what Dad would do a lot in the chiropractic days when he would buy the adjustment tables, the, headrest paper. I even remember like when we were about to sell the last office, they even got like the equipment, the laser like lipo. I remember that. But right, so that machinery, okay? How can I go and buy that machinery and then get all the money back for it? Now, just a quick recap, right? So the machine, it's a whole life insurance policy. And again, the whole life policy has to be designed for high immediate cash value. So now here's where the paradigm shift starts to happen, okay? Your premiums, there's premiums that go inside of this policy. Your premiums are your deposits. Okay. Yes, it's a payment, but in my opinion, it's a deposit. And why do I call it a deposit? Well, because if I put money into an account that I own, I control, and I have immediate access to the cash, is it treated more as a payment or a deposit? I think it's a deposit. What word y'all like better, payment or deposit? So there's premium deposits that go inside of this policy. And think of it this way. Just as you make those deposits into somebody else's bank, Wells Fargo, Bank of America, et cetera, you're just flipping the script. You're making your deposits into your own bank, your private bank. So there's premium deposits that go into this. Now, there's also age and death benefit on the policy. And I'm going to blow this thing up. You're going to notice that age and death benefit are grayed out. And why are they grayed out? Because they do not matter. Oof. I just hit a chord with some of my analytical folks. And if I don't talk about age and death benefit, you're not going to hear anything that I say moving forward. So let's just talk about age and death benefit, and we're just going to walk through it quickly, okay? Let's make believe that we have three individuals, age 20, 40, and 60. They're all in the same equal health. And let's make believe they have a $20 bill in their pocket. So age 20, 40, and 60, same equal health, $20 bill. They all walk in to the grocery store. Who between them is going to be able to buy the most amount of groceries with their $20? Well, all of them, right? Doesn't matter how good you look, how bad you smell, how old you are, the color of your skin, the language that you speak. I mean, the same $20 is going to buy you the same amount of groceries. But now let's take that same example 20, 40, and 60, same equal health. They have a $20 bill in their pocket. They walk across the street to the life insurance store. Who between them is going to be able to buy the most amount of death benefit with their $20? The younger one. That just makes sense. But I'm not here talking to you about the death benefit. Death benefit's going to be on this policy whether you like it or not. I'm here talking about the cash and the cash value that I can use from this policy. And I really want to drive that one home because I'm going to get done here today and someone's going to come up to me and say, Hannah, this stuff was very powerful, so cool, but I'm too old to do this. No, you're not. Just because you're older means you're going to have a lesser death benefit compared to somebody like me who's in their 20s. But if we put the same amount of premium into our policies, the cash is going to be the same. Does that make sense? Okay, let's move on. Starting on the left-hand side, this is just time. Year 1 to 8, year 9 to 13. Then you have your premium deposit. Now, in this example, we're using $10,000 a year. You may be thinking to yourself, Hannah, I would never put $10,000 a year into a stupid life insurance policy. I get it, all right? When I started my first policy at 18 years old, I was still a waitress at Cracker Barrel, all right? Do you think I had $10,000 to put into a policy? No. So I just started where I was at. I was saving $100 a month. Dad came to me and says, okay, now that you're 18, you're saving 100 a month. That's excuse me. Now that you're 18, you're saving $100 a week. That's $400 a month. That's where you're going to start your first policy, $400 a month. So you get to decide how much you want to deposit into your policy. So if 10,000 is too large of a number, shave off a zero, do 1,000. If 10,000 is too easy, add a zero, do 100,000. I don't care. You get to decide how much you want to deposit into your policy. So in this example, he just says, okay, I know I'm worth $835 a month. I'm going to put $10,000 a year into this policy. And you'll notice that he pays those premiums over the course of the next 7 years. Now, in year 4, we're in the market and we want to go buy ourselves an x-ray machine or maybe, like I said, a decompression table, some piece of equipment for our office. Now, I will mention I would never have you wait to the 4th year to start using the cash that's available in the policy because how soon did I say the cash value is available to us? Immediately within 30 days. I'm just really doing this to isolate the equipment purchase here. But in year 4, we want to go buy ourselves new equipment for the office. So it's going to cost us $25,000. Where do I pull the $25,000 from? I pull it from the cash value that's inside of my policy. So I take out the $25,000, I walk into the store, I hand over the money, they hand me the x-ray machine, and then everybody walks away. The transaction's done. But now, because I borrowed from myself, don't you think it's a good idea that I should pay myself back? Pay myself back with interest? I see a lot of, yes, Hannah, that sounds like a great idea, but y'all ever do it? No. Here's what you got to do. Treat your money just how you treat the banker's money. If you're going to borrow from yourself, pay yourself back and charge yourself interest. If you don't, all you're saying is that the banker's money is more valuable than your money, and that's just not the truth. So he says, okay, because I borrowed from myself, I'm going to be an honest banker. I'm going to pay myself back and charge myself interest. So what he does is he pays himself back $500 a month or $6,000 a year over the next 5 years. So let's just see what happened from year 1 to year 8. He put in 70,000 of his premium deposits. Plus, he put back 30 for the x-ray machine. So a total of 100 has gone into the policy up to this point. But he did take out 25 to go buy the equipment. So 100 went in, he took out 25. 100 minus 25 is 75,000. So 75,000 is my true net injection, yet I'm sitting here at year 8 with 73,226 as cash value in my policy. If you take that 73 and divide it into 75, you just got back 97 cents for every dollar that you spent on that x-ray machine. Wait, Hannah, hold on. I'm not getting it. I'm not getting it. How is the money still growing even though I've taken it out and I'm using it? All right, if you've been sleeping up to this point, now it's time to wake up because here's a big aha moment. Do you remember earlier when I asked y'all, hey, you guys love paying cash for cars because you think when you pay cash for stuff, there's no payments and no interest? Well, here's what's happening. If he had this 25,000 just sitting inside of his checking or savings account at the bank, and he went and just withdrew the money from the bank and handed it over to buy the equipment, okay, he's accomplished the goal of buying the equipment, but guess what he no longer has? He no longer has that 25,000 because that 25,000 was sitting in his pocket earning him some form of interest down at the bank. And when he went and just withdrew it out to go pay cash, well, now he's got to go out there, work for his money, earn it somehow to get that 25,000 back inside of his pocket, earning him interest again. So when you start to just add the one additional step of running the money through the policy first, you never interrupt the compounding interest of what's happening in the policy. Uninterrupted compounding interest. Because here's what's going on. We are not withdrawing the money out of the policy. No, we're taking out a policy loan. So what that means is I'm putting my policy, my death benefit up for collateral, and I'm taking a loan from the general funds of the insurance company. So I'm using the insurance company's money in the real world, and that's how and why my money still remains in the policy to grow and compound as if it wasn't even touched. I mean, is that cool or cool? I don't know any other vehicle on this planet that allows you to use your money, spend your money, and then save it at the same time. But let's move on because maybe we expand, maybe we're opening up a new location, or maybe that one broke. It was a faulty equipment and it broke. I don't know. But we're in the market and we need to go buy another x-ray machine or maybe another piece of equipment for the business. And so in year 9, we want to go buy ourselves another $25,000 x-ray machine. Now, at this point, there's no more premiums going into the policy. But I'm telling you right now, if I'm a good coach, you will quickly understand that you want to pay these premiums for as long as you can and as much as you can. I kind of make the joke, have you ever made too many deposits into your bank account? I hope the answer is no, right? Your premiums are just your deposits into your private bank. But again, just for learning purposes, there's no more premiums going into the policy at this time. So in year 9, we want to go buy ourselves another x-ray machine. It's $25,000. Where do we pull the $25,000 from? We're pulling it from the cash value in the policy. Now I'm going to do the same exact thing. Buy the x-ray machine, and then I'm going to be an honest banker. Pay myself back with interest, $500 a month or $6,000 a year for the next 5 years. From year 9 to 13, let's see what happened. I put back 30 for the x-ray machine, pay myself back, but I did take out 25 to go buy the machine. So I put back 30 and I've taken out 25. 30 minus 25 is $5,000. So $5,000 is my net injection, yet I'm sitting here with 95 and some change as cash value in my policy. Your cash just grew over $22,000 with the $5,000 net injection. How do you like buying the equipment my way? Again, is there anything stupid, ridiculous, or idiotic here that I'm doing? No, I just am using the policy. You are going to go buy the equipment anyways. And so now that I know a smarter way, I'm just going to do it this way and get all the money back for it. But let's see what happened, okay, from year 1 to 13. Because 13 years goes by pretty darn quick in our life, does it not? 13 years ago, I was 13 years old. Oof, that's a little scary to think about. Let's just see what happened here. You put in 70,000 as your premium deposits. So 70 plus 30 for the first X-ray machine loan repayment, plus another 30 for the second X-ray machine. So we put in a total of 130,000 into the policy up to this point. I took out 25 for X-ray 1 and took out another 25 for X-ray 2. So I put in 130, I took out 50. I put in 130, took out 50. 130 minus 50 is $80,000. $80,000 is my true net injection. Yet I'm sitting here at the 13th year with 95 and some change as cash value in my policy. Did I just show you how to get all the money back for the equipment that you're buying? So guess what else he has? He has the 95,000 in cash, but he's got 2 machines that he can sell, donate, do whatever he wants with them. So how much did it really cost me to buy this equipment? I mean, my simple mind is thinking, really, it cost me nothing. I kind of made a little bit of money by doing this. But I can't sit here and tell you that it cost you nothing because you had to start the policy. You had to start this system. Year 1, when he put in 10,000, he didn't have access to that full 10,000 quite yet. But are y'all in this for the short term or the long term? You tend to tell me long term, but you get hung up in short term thinking. See, this is not a get rich quick kind of deal. This is a lifestyle. This is a process that you're adding to your financial life. And I don't know if you've ever heard of a gentleman by the name of Rick Warren. Rick Warren wrote a book called The Purpose Driven Life. And he says, life is like a marathon. It doesn't matter how you start, it only matters how you finish. This is the game of life. But there are some rules to this, right? Rule number 1, pay yourself first. If you get nothing else from my talk here today, pay yourself first. I know you guys hear that all the time, but do you actually do it? Probably not. So what I mean is when you get money that comes in, take a sliver of it. I suggest at least 10% and set it to the side. Pay yourself first. Treat yourself as your number 1 asset and then go pay everybody else next. And in my opinion, the pay yourself first money should be the premiums that you're depositing into your policy. So rule number 1, pay yourself first. Rule number 2, pay yourself back and pay yourself back with interest. Treat your money just how you treat the bank's money. Again, if you don't, all you're saying is the banker's money is more valuable than your money. And that's not the truth. And then rule number 3 is recycle and recapture all of the dollars. So y'all, I just use this as an example of equipment. Let's say instead of this being 10,000 of premium, it's $1,000 of premium, and this is a $2,500 MacBook computer. And then I just pay myself back $600 a year. Does the concept still work the same? Yeah, it's just smaller numbers. Or if this is a $100,000 premium and this is a $250,000 office building or a house, and then I just pay myself back $5,000 a month or $60,000 a year. Does it still work the same? Yeah. How about my real estate investors, right? Let's say this is a $2.5 million property for a fourplex. I don't know, an apartment building, right? Does it still work the same? Yeah. I'm a lender on real estate. That's just what I like to do. Let's say Dr. Matt calls me up and he says, Hannah, I need 25,000. I need to go do this rehab on this property, and I want you to loan me the money. Okay, Dr. Matt, I'll loan you the money. Where do you think I pulled the 25,000 from? I pull it from the cash value in my policy. Now, who do you think is paying me back this 500 a month or 6,000 a year now? Dr. Matt's paying me back now. Ooh, that just got really fun, really interesting, did it not? See, I don't care what it is. You are turning every liability into an asset, every depreciating asset into an appreciating asset simply by running it through your own banking system first. And there's other resources I can give y'all. A lot of y'all know Robert Kiyosaki. He's famous for the book Rich Dad Poor Dad, but he also wrote another book called Second Chance. And in that book, Second Chance, Robert Kiyosaki talks about this concept. But y'all read right through it and didn't think a second thing of it because it's never been explained to you this way. Or Tony Robbins. Tony Robbins wrote a book called Money Master the Game. Chapter 5.4 in that book, Tony Robbins talks about this. But again, read right through it, didn't think a second thing of it. So I just encourage y'all, think for yourself, research this stuff, okay? Because if it works for a car, what else does it work for? Oh, I wanted to also mention, hey, when we were using this in the chiropractic days, the equipment purchase, we can write this off, right? So it's a business expense. I can write this off. So I can also write it off. Plus, I can get all the money back for it. Ooh, that just got really fun, didn't it? Taxes, charitable giving. I mean, seriously, anything that you're spending money on, get all the money back for it. All right, here's some resources, some more resources that I would add to your wealth building library too, okay? Second Chance, there's that book, Robert Kiyosaki. There's Tony Robbins, Money Master the Game. And then also Larry Steinhaus, he has this book called Money Hacks. Chapter 13 of that book, Larry talks about this concept. And matter of fact, Larry and we have an event that's coming up at the end of this month in Tampa, Florida. So for all my Floridians or my folks who are up north and want to get out of the cold, as I say that, though, it's kind of chilly in Florida right now, if you guys been seeing the news. But at the end of this month, we are hosting an event in Tampa called Money Game Live. It's just moneygamelive.com. You can go and see what it's all about there. But more importantly, why I like to put Larry's book up here, it's the subtitle. Because everything you think you know about money is wrong. And I just love that. So hopefully that was insightful. I got one last thing that I can share with y'all too, if we kind of want to get into a little bit of like a lot of the FAQs that I do get. I got to share my screen here. Sorry about that.
Hey, Hannah, I had a quick question for you.
Go ahead. Yeah.
It's interesting because you talked about the big banks, and I like to follow what big banks do, institutional lenders, because they're way ahead of the curve in a lot of situations because they're going to protect their money. And without going into detail on the quote banking cartel, I mean like that's a number one. So when you talked about the fact that they own more whole life insurance policies than anyone. I mean, you got to think about that, right? If the big banks, big institutions like that are investing heavily in this much, and listen, there's risk in everything, obviously. I mean, but when you compare it to, let's say, a traditional 401k that is tied to a corporation or the stock market, I mean, can you give me your thoughts on that? Because I think a lot of people like, well, I got a 401k, I do this and that, but to put it in perspective, if that makes sense. I don't know if I
Yeah.
articulated that.
No, no. Yeah. It's essentially why are we storing the money there, right? Number one, people are storing their money in those qualified accounts because, well, that's just what my boss told me to do. That's what my colleagues are all doing, right? My parents did it all, right? The number one risk factor when it comes to these policies is you and how you use your money. And who do you know better than you? I mean, seriously, because the policy is not tied to the market. Your 401k, in my opinion, it's an investment, right? A lot of people like to look at it as, oh, it's my savings account. No, it's not. It's an investment. My definition of an investment is it can go up in value, but it can also go down and lose value. There's some risk there. A lot of people called me up during COVID time. I remember this one family in particular. They're out of Cleveland, Ohio, and they have about 8 policies with us. And she calls me up and she's like, Hannah, I should have listened to you because because of what happened with the markets here in 2020, my 401k just tanked over $100,000. I mean, seriously, what if she was going to go and retire that year, right? So to me, right? I'm never going to tell y'all how to go make your money, how to invest the money. But if you want to have those buddy conversations, I'll turn you on to what I'm doing, what's working out for me over here. What I'm talking about is where are you storing your money at? And then through the policies is how you go buy your investments. So if you really want to go put money into that 401k, that's an investment, put the money in the policy first and then go put it into the 401k. No, I'm just kidding. But seriously, like when it comes to retirement, and I have a lot of content on this on my YouTube about supplementing income. I'm going to take tax-free income during retirement. I put no money in the markets. I have no 401ks, no IRAs, no qualified plans whatsoever. Because my retirement strategy is I'm using my policies, my good dollars today. Because think about it. Your money is worth more today than what it is in the future. And if you ever forget about that, think about how many candy bars you could go buy 10 years ago for $1 and how many you can buy today for $1. So your money is always going to be worth more today than what it is in the future. And then when you go and put your money into those qualified accounts, you got to still pay the taxes on it. Yeah, you can avoid the 10% penalty by waiting till age 59 and a half, but you're still kicking the can down the street because you're still going to have to pay the tax on the money when you want to go and take those distributions out, right? So for me, it's like, why are we giving up our good dollars today to get paid back with non-guaranteed weaker dollars in the future? It's just so backwards thinking. And I can get on my soapbox and keep going on and on about that, but hopefully I answered the question okay.
That was perfect. If you have a question, feel are we at the Q&A time, Hannah? Can you take a few questions or
Yeah, yeah.
yeah, if you have a question, just unmute yourself and ask. I know we have a question in the chat. It says, as a 60 plus male, I would think the cost of insurance is greater than any gains from the investment sub accounts and any potential tax savings. Thoughts?
Yeah, so go back. I don't know, iPhone, if you heard me say this, but remember my three examples, age 20, 40, and 60, right? Age only affects the death benefit. And that's not the reason that we're meeting here today. We're talking about the cash and the cash value in that policy. So, for example, I'm 26, right? Let's just say you're 66. Sorry, I'm just putting just easy math for me, okay? 40 years difference. If we put the same premium into our policies, the cash value is going to be the same. But because I'm younger, my death benefit is going to be higher compared to you. That is the only thing that changes when it comes to age. And that's the biggest misconception when it comes to this infinite banking concept. People think, oh, well, I'm just too old to do this. No, you're not. It only affects the death benefit, it does not affect your cash value in the policy. Actually, Miss Sonia, if I can, I see maybe Sonia's writing in the chat box, but Sonia is if I can say that, she's within her 60s, okay? Sonia's starting her policies. And she is at that age starting this because she understands that, hey, I know I'm not doing this for death benefit purchases. I'm doing this because I'm about to go open up this new practice outside of Dallas, Texas, and I want to use this money to go finance this new office for myself, you know? Sorry, I got a little passionate there.
Mm.
Let me tone it down a little bit.
Well, she says, if I have money in an IRA, how do we strategize to put money in the WL insurance policy and I don't have a tax hit?
Yeah, yeah. So actually, Yvonne, you're gonna have to, I mean, because premiums that are paid inside of the policy, it's after tax money. Okay, so after tax money goes into the policy, and then now it's an environment where it grows tax free. Matter of fact, let me get to that page real quick just to give you all the bullet points. Here you go. Internal values grow tax free. Okay. Oops. There you go. So after tax money goes into it, and then now it's in that environment where it grows tax free. So now that it's in there, then any distributions that I take out from the policy, that's going to be all tax-free monies to me. Actually, Yvonne, if you want to talk offline, just yesterday I was speaking with another gentleman, Jose, and he's actually taken his money from his IRAs. He's 65. He's starting his second policy with us now. And he says, Hannah, I need to go buy this car, but I don't want to just take the money from my IRA and go pay cash for the car directly because then I will never have that money again. So I'm ready to start my second policy because I want to take that money and do a dump in into this policy. And then immediately I want to take out that 90% and then go purchase the car with it. All right. But there's no way to really avoid those taxes by taking it out. You're going to have to pay the tax on the money.
Good
Okay.
question. If you have a question, just unmute yourself, or you could type it in the chat, either or. Any questions? That was awesome, Hannah. Thank you.
You're welcome. You're
So
welcome.
good, so good. Even better when you actually use the method and you're there. But
And I'll be getting deeper into this when we're in Atlanta today. I know there's a lot of parts that I skipped over, but
mhm,
but we will.
mhm.
Um,
And we will have the replay. So if you've come in late, I'll post this on social media and or I will send you an email so you can watch the replay. Lots of gold nuggets here, and I think it's going to really expand your mind too. Any questions specifically?
Good. Hey, and then if you want, you can go to our website, themoneymultiplier.com. You can see the full presentation that way as well. You'll meet my father, Brent. Okay, you can kind of hear him. He's got a little bit of a different teaching style than what I do. And then you got my cell phone number, then my email right there as well. So reminder, send me an email if you guys want that ebook, Mapping Out the Millionaire Mystery. It's a great resource, very easy read. I read it on a 4-hour flight when Dad and Chris just came out with that book. Um, but yeah, just study up on it. That would be my biggest ask is just really research this stuff and think for yourself and question is what I always say.
100%. Absolutely. Anyone have any questions? Other questions? Just unmute yourself or drop it in the chat. When you start a second policy or subsequent policies, is it the same exact process? I'm sure, or is it like a shortcut now? How does that work? Is it all systemized? Like what is the
So at the end of the day, it is a life insurance policy, right? So we do have to go through the approval process to qualify on the health side for the policy.
Mhm.
Now, real quick, let's say somebody is uninsurable. My older brother, he was on kidney dialysis for a long, long time, actually got a kidney transplant. No insurance company will touch him right now. But he has a business. He runs a property management business in South Florida. He's got employees. He's married. He has 2 children. He still does this because he can put policies on other people's bodies, right? But in order to qualify for a policy, if you're going to be that insured person where the death benefit's going to be on you, step one, application, just a yes or no health questionnaire. And then the second step is the exam. Okay, so the exam is just like a basic medical, if you will. The nurse will come to your house, they'll take a little bit of blood, you'll pee in a cup, stand on a scale, and then all of that information will get sent over to your underwriter. But after those 2 steps, that's all of our legwork, and then hopefully we have that approval. So to answer your question, the labs are good for 1 year. So that's why 70% of my folks come back before the first year's even up because they want to use those old labs, right? But you do have to
Mhm.
do a new application at the start of every new policy.
Got it. Because she said, how many policies can you open up in 1 year, assuming you got approved by the underwriter? Is there a limit to the policies in 1 year or?
Really no limit. To get technical, it's the death benefit. Because these insurance companies are always looking at this from a death benefit perspective. Where I know us over here, we're always looking at it from how much cash and how much premium can I stick inside this policy. So just how you cannot overinsure a car, you can't overinsure a body. So there's going to come a point in time where you go back to the insurance company and let's say you have $20 million of death benefit on your body and you try to go back getting an additional 2 million. They may come back to you and say, "Hey, we feel like you're adequately insured with the 20 million," right? Because that could happen. But I don't see that until we get into those millions and millions of death benefit. But honestly, as we grow and evolve in our lifetime, hopefully income is rising, assets are rising, that we can qualify for more and more death benefit as time goes on. But even if we can't, hey, Put the policy on somebody else. I have policies on the key employees within my business, right? I'm using the policy because I want to use the cash values, but I'm also using it from a protection standpoint because if Jamie gets hit by a bus tomorrow, I'm going to have some loss of income in my business. There's some risk there. And I'm going to need those resources to go and find myself another replacement because she's a key role within my office, you know?
Makes sense.
So yeah, we're just scratching the surface. There's a reason Nelson calls this the infinite banking concept.
Great questions. Anyone else before we wrap up? Just post it in the chat and or unmute yourself. And like I said, we will post this recording on social media as well as I will send an email out to the list and make sure you grab Hannah's information. Throw that slide back up, Hannah, real quick. I'm sorry.
Yeah, yeah,
Yeah,
all
make
good.
sure you have that. Scan the QR code and download that book. Any other questions? Last chance.
Hey, Dr. Matt, if I can say, and Yvonne, if you want to chime in as well, um, student loans. I know a lot of us on this call may still have some student loan debt. I would encourage y'all reach out to me and I'll make a connection with y'all with this a gal on my team. Her name is Rachel Katz. She's based out of the LA area in California. But she is a single mother and she had two boys, and when she was raising her boys, she was just struggling to put food on her table because of all this massive student loan debt that she had. And she really figured out the student loan game, understanding the government and state sponsored plans that are out there. And like Yvonne, I know you're working with Rachel. I mean, has she gotten your payments down?
Yes, we are. Hi, Hannah. Thank you. Yes, we are working with her and we are in the process right now. We are very, very happy that you connected to us, I mean, with her.
Oh, good, good. Hey, and what I'll do too, Doc, if it's okay, I'll just put
Mhm.
Rachel's email in the chat. But it's just funny because it's just they don't want us to know about this stuff. Just like the infinite banking concept, think about it. If all of America was doing this, bankers would have no customers. They would have no depositors at their banks, right? So there's kind of a reason some of this stuff gets hidden and is not so public education forefront and knowledge, right? You kind of have to go out there and seek for it. So for all my student loan people, I would consider reaching out to Rachel because the feedback that I get is, hey, thanks for sending me to Rachel. She just totally eliminated my payments or drastically decreased the payments I had to pay.
Dr.
That's great. Okay.
Dr. Luke, I'm sorry. I want
Yeah.
to thank you for giving us the opportunity to be here today and to bring in Hannah to give this information to all of us chiropractors that we don't know anything about this. At school, they don't teach us this. We really don't know, and this is a great, great opportunity. Thank you so much.
You got it. I mean, the goal is to help empower you as well as me. I take notes, so I want to learn even more so than what I have. And as I mentioned in the beginning of this call, like I need more policies because now we're starting to utilize it. And like, oh man, so Hannah has been a wealth of knowledge in particular. So again, thank you so much, Hannah. So yeah, you dropped the email in the comment section there. Okay, great.
Hey,
And
and Dr. Matt, you know what our mentor says? He says, always appeal to self-interest, right? That's what I do all the time. Fun.
awesome, awesome. All right, gang. If you have any questions, you know where to find us. I will post this recording. Thank you so much, Hannah. It's been a pleasure, and we shall chat soon. Hope you guys have a fantastic day, and let's keep the momentum building. Cheers.
Cheers. Bye, y'all.